We're back with Investment 360. Lindsay is still in Cape Town and Ashraf and Mark are still in studio with me. That's to wrap the top funds and investment insights in South Africa and beyond. Remember to join the conversation on Twitter at CNBC Africa, #Investment360. Wall Street's largest banks say the slump in emerging market assets that saw equities trailing advanced nation shares by the most since 1998 will prove more than a fleeting sell-off. Stephen Schultz, head of international fund solutions at Momentum Wealth International, joins us for more insight. Stephen, let's unpack this emerging market story, and I know we're going to put up a quick graph to illustrate that the emerging market story, in your opinion, still remains intact going into 2014. We are going to outperform both the US and Europe.
I wouldn't go so bold as to say that we're going to outperform. My comments merely related to the fact that I think that emerging markets still place a significant portion of clients' investments. I wouldn't be ignoring emerging markets, as you can see from the graph.
So just explain the graph here to us.
So if you have a look at the blue bars, those are emerging markets, aggregated GDP growth. So you can see that it's still coming in at around 5.5%, significantly higher than some of the more popular developed markets. The USA, you can see there in the silver color, starting to pick up now. We're expecting in 2014 forecast just under 3%. And then most interestingly in the red at the bottom you see a turn in Europe. So that's aggregated Europe, slowly turning positive, and more importantly it's broadly positive. So some of your traditional distressed countries such as Spain, Greece, Italy are starting to show some robust signs of growth, which is encouraging.
Stephen, don't you think if you look at the bigger picture, the more general picture, you could say to yourself that the emerging market story became so incredibly fashionable. Everyone was jumping on a plane and going to Africa and going to Vietnam, and it all got a little bit overblown. So this correction is entirely natural. It was overbought and now it's become maybe a little bit oversold or just correcting to fair value. The other thing is, of course, that this giant washing machine of money in the world goes from one asset class to another, from one geography to another. So emerging markets are now out of favour. Developed markets are very much in favour, which whereas I speak, I see the Dow Jones and the S&P 500 going to all-time record highs. So money being diverted into developed markets at the expense of emerging markets. So it's entirely natural. It's just a cyclical thing. Emerging markets for the long term must be a good thing.
To some extent, I do agree with you. If we have a look at the word cyclicality there, so if we have a look at a Schiller PE, which is pretty much a business rounded 10-year smoothed measure of the market's evaluation, so purely a valuation perspective. Emerging markets currently sitting at about a 14 PE, whereas your developed markets, US in particular, sitting at a 25. So it depends on how long you draw that line back in terms of the trends, but I'd argue from a purely fundamental valuation perspective, emerging markets still pretty compelling.
Just on that point, if we take emerging markets like Brazil, Turkey, South Africa, from an international purchasing power point of view, we are sub-emerging markets. So from that point of view, if I'm looking at it from Boston or Edinburgh or Zurich, it really isn't looking particularly attractive. So what makes them so compelling if their currencies, almost without exception, are in the lavatory?
Look, I think it's very difficult. I'd be very hesitant to paint all emerging markets with the same brush. First off, if we reference the rand as we saw today, breaking through 10.90.
Yeah, but it's the same against the real. The rand's been pretty steady against the real for 5-6 years now.
True. I think the fundamentals that are sort of underpinning it, and that's the washing machine of money that's been referenced, very much intact. You're starting to see now tapering come through. You'll see interest rates steadily rising in the US, and naturally you'll start seeing portfolio flows back to their home countries, money of which was always fickle, which we've had the benefit of for the past 5 years, and that will reverse. So naturally you will expect our currencies to depreciate, that interest rate differential will slowly thin, and money will divert back. But I think you should distinguish between the capital flows of the world as well as the fundamentals. And from a fundamental perspective, I say that it's very difficult to paint every country with the same brush. South Africa in particular. So if you look at South Africa from an investor's perception, a foreign investor's perception, there's a few standouts in South Africa that I would argue are responsible for the recent weakness in the rand.
Ashraf?
Okay, just when you're looking at emerging markets and you start splitting them, you look at the countries such as Vietnam. Thailand's had a few recent problems, but
sure,
nothing significant. And then you look at countries like Colombia, etc. I mean, those are still very attractive regions with lots of growth opportunities. So, does one say just paint them all with the same brush, or do you go almost country picking?
I would go country picking. So that's, you pretty much preempted my conversation. I think ideally what you would look to have is a very well diversified, balanced portfolio. So there's certainly a place for developed markets as well as emerging markets. And within the emerging market space, I think it's very important to be selective as to where in the emerging markets you would go. And I'd particularly reference, I thought it would be a nice topic to discuss some of the mints, which is a term that's been coined by Jim O'Neill, a gentleman from Goldman Sachs, the same gentleman who identified
This is a new term for us. So this is about on this desk like fabulous, because we
Yes.
only just got our heads around that.
Sure.
So break down the mints for us, and then I know Lindsay is dying to come in.
Sure. The MINT stands for Mexico, Indonesia, and Nigeria, as well as Turkey. So those are four countries specifically within emerging markets.
Mint, is it? What's happened to the S?
The S is a no feature. Just as a nice
It's just a sexy addition.
Correct.
The mints.
So those four countries in particular have been highlighted by Goldman Sachs. It's on a 35-year forecast, so one would argue that that's probably a little bit long and possibly over-ambitious. But these four regions are part of the new frontiers. It's a new, fresher take on BRICS. And Goldman Sachs argues capable of those double-digit GDP growth that China became famous for in 2003 to 2008. So the fundamentals are in place.
I find this actually extraordinary. I find this extraordinary that Jim O'Neill can influence the world's international asset class flows by coming up with BRICS first of all, then he comes up with mints. I can come up with some really, really rude 4 and 5 letter words, but they would be palatable to the average international investor. What I want to know is
our audience
geographically, Bronwyn, you can come up with a story and say, right, I like this country because it's politically stable and because it's geared to fast-moving consumer goods because it's got a youthful population. Is that the way to go for it? Or is it to say, like Standard Chartered have done over the last week or so, and invested 13% via their private equity division into a Botswanan a grocery chain? I don't think geographics are really that important anymore. I think it's actually stock selection and sector selection. Do you agree with me or not, Stephen?
I do agree with you. From a geographic perspective, I suppose it depends which way we're going. So taking a look top down, geography plays an increasingly important role. All four of the countries which I highlighted have an advantage from that perspective in terms of trade routes. So they can sort of, through those four regions, lock in the world. And in so doing, hopefully drive some sort of GDP growth. The numbers, as you mentioned, a youthful population, very important in sort of cementing returns in those regions. But just to quote a small reference, these are coming off very low bases, Nigeria in particular. If you have a look at Nigeria, Nigeria's got 170 million people that feed off the same energy that 170 million Nigerians are currently utilizing the same energy as 1.5 million residents of the UK. And in so doing, they're already achieving 7% growth. So given the correct infrastructure, the sky's the limit.
Quick one, and then we're out of
So
time.
let's just finish off. So from my experience, this big picture is all well and good, but the investability of these countries that you referred to is poor. You can't get access to public markets like you can in South Africa, for instance, even.
Sure.
Many companies are privately owned, family owned, and sometimes it's difficult to get hold of public stock. So how do you invest in this lovely scenario?
Sure. I think that's you've sort of hit the nail on the head. The challenge doesn't really lie in the potential. Potential's a no-brainer. In terms of investability, I think that's where active management becomes increasingly important. Liquidity is the major concern whenever you're referencing any of these frontier markets, and these would be no different. But then again, this is more of a 35-year view. So you would expect markets to develop in those 35 years, and there's obviously a lot of boxes that need to get ticked along the way before these truly do become powerhouses.
Stephen, thanks so much for your time. Stephen Schultz, Head of International Fund Solutions at Momentum Wealth International. That's where we leave it for Investments 360 this evening. We're heading into a short break and we return with your view. Remember to call us 011-384-0598 or you can tweet at CNBC Africa, #YourView. Stay with us.
Certainly in the studio gives you that.
And it's quick with or like a lot of guests, even though we don't say a lot each. For the viewer, it's you must tell me what your mum's trying. You know, I like it. I love her feedback.
She's an avid
Len-